when we think about the four phases of financial due diligence, let's let's think about where are we in the process? So if you have a signed LOI and have started out with due diligence, typically you're granted anywhere from 30, 60, or 90 days of exclusivity to analyze the business from a financial, tax, legal, and other operational risk standpoint to make it sure that the business you're looking to purchase is sustainable and viable. So financial due diligence is a core component of this process. Typically, once you have a signed LOI, you should kick off financial due diligence within the first 1 to 30 days of your exclusivity period during your letter of intent. Um, Additionally, when that process kicks off, it's also helpful to start the SBA or a private credit underwriting process to solicit a loan. The reason why both should start in the early innings of your LOI is because if there are significant financial information that's unpacked, you want to learn that earlier rather than later, before you begin things like tax and legal. If the financial analysis component comes back and the business is looking a little bit different than what you anticipated before you submitted that LOI, it's important you know the sooner the better. So typically within the first 1 to 30 days, you should conduct and complete, financial due diligence. So if you are actively searching for a business, keep this timeline in mind and feel free to screenshot or share, bookmark this on your desktop. So when you do have a LOI, you can kind of hit the ground running right away. Um, so when we think about the four phases of financial diligence or a phase diligence approach, the question I get asked a lot is, what is a phase diligence? Why does it matter? And, how does it impact my deal? So typically when you conduct financial due diligence, typically you will assess the financials of the company. But rather than doing a long-winded exercise that takes, multiple weeks, etc., why wouldn't you break it up into bits and pieces of, conducting this analysis, rather than spending a bunch of time and money doing a full-fledged report when it doesn't get through the various checkpoints. So the various checkpoints are what is called, the phase due diligence. So the first sort of milestone we like to start out with, which is called, phase one, is the financial validation and baseline assessment. So really the point of this first phase is to ensure the data is accurate and validated against the credible source documents. So what that means in very simple terms um, is the business financials on a revenue, expense, and profitability standpoint tie back to the raw accounting data, the data that was shown on the tax returns? Does it tie back to the bank statements? This initial preliminary analysis assesses whether the information presented in the summarized format on the LOI or the SIM is accurate to the financial records of the company. And the reason why uh, we like to start with this phase one is because if the high level information in the source documents are not tying out to what was shown in the SIM or the marketing materials, there's no point to start detailed analysis of any kind until you have set that target baseline assessment. So the way you set that really is through collecting the financial and operational documents, um, loose level tick and ties and validation against the source documents. So comparing the general ledger, which was run in the QuickBooks accounting system, compare that to what is shown in the SIM. Compare the revenues and expenses to what is shown in the tax returns. If there are differences, understanding why there are changes at a high level with management before doing a deep dive into the business. The second piece, third and fourth, really sets the stage for once the deal is validated and the data is validated, how do we move from the signed LOI, doing detailed analysis to answer some of the questions you have about the business, putting together a financial model and operational deep dive, and then working together to protect closing, which is, the fourth phase of the diligence process. This phase diligence approach is something we take for all the self-funded searchers, acquisition entrepreneurs, et cetera, as part of our due diligence procedures. Um, if you stick around a little bit later, I'll be sharing the Business Buyers Toolkit, it'll contain things like the financial data request list. So stick around for that. All right. So moving through the rest of phase one, so we're going to be doing things like the trial balance reconciliation, a tax return alignment, looking at the consistency of the income statement and balance sheet, uh, and then conducting a preliminary net working capital analysis. A lot of these buckets can be things you think about as you may be looking at prospective companies. If you're sitting in that pre-LOI phase, knowing some of the analysis you'll need to do, or some of the analysis the service provider or CPA firm you hire needs to do, is very important. So if feel free to save and screenshot these slides as we kind of work through them. One thing I like to call out is at the conclusion of the phase one. So picture this. You've conducted the analysis and you have loosely validated that the revenues at a high level are in line with the revenues you were shown in the SIM and the revenues you used to submit that LOI. Once you have loosely validated everything in phase one, you want to put together a phase two roadmap, which is going to set the stage for your deeper dive of analysis. So once the data is validated, now how can you perform some of the analysis to answer some of your questions? Some of the questions are going to be like, what is the customer concentration? What are some of the cash flow requirements of the business? Does the business have payroll, a significant amount of people on payroll? What does that look like? So once you do set the stage, phase two makes it very painless to answer some of the big ticket items of the business. So why does this work? Why why have I seen the phase approach a superior product and results? It really sets the stage for cost efficiency. So some of the pain points of conducting a full-fledged QV is it can be very expensive. And in my opinion, if you don't get the validation first and foremost, there's no point to spend a bunch of time and money on analysis that doesn't make sense. If the business is materially different once you see under the hood than it is when you were looking at the car, uh, it also creates a faster timeline. So the phase diligence, the four phases, is to be conducted, anywhere from 3 to 6 weeks. So it allows an accelerated timeline for conducting this analysis. It then goes into a higher detection rate of issues. So if you break up analyzing a small business that's been around for 10, 20, or 30 years into several pieces, you can better detect issues throughout the way. So if you don't get through phase one, you likely will have issues about the financial validation. Phase two, if you can't run customer analysis, et cetera, those will be other issues, and it'll begin to detect more problems. So phase two, let's unpack this. This is going to be the bulk of the quality of earnings and your value analysis of the target company you're looking to buy. So it starts with a discovery. You're going to gather some of the financial records and the contracts. You're going to start analyzing the earnings, consistency, and adjustments, and conduct what is known as a value assessment. The value assessment really is these three core items. So it's going to be an earnings normalization. This is going to be when you identify and quantify one-time discretionary items that distort true earnings. Um, the value assessment also is going to look at what are your working capital analysis? So what are the working capital requirements of the business? Typically, working capital is a balance sheet analysis, which represents current assets minus current liabilities. Once you determine what is your calculated working capital, you need to identify and set the purchase agreement peg. So the net working capital peg is a specific number based on your working capital analysis. Um, if you head over to my YouTube channel, I have several specific webinars where we do a deep dive in working capital and we calculate it using an Excel model. I encourage you to, check those videos out because they are very hands-on and helpful. Um, Looking at the revenue quality testing, so when you're assessing the revenue streams of the business, you're going to look at things like what is the revenue by customer? What is the revenue by product? Does the company serve several geographies? Does it serve customers by, countries? Is it inside the US, outside, international, et cetera? Doing a revenue quality is important because it unpacks what is the health of the revenues of the business. Um, so it's an important piece of this value assessment. Additionally, in the value assessment, it's going to do deeper dives into a few areas I think are very important. So if we just focus on the boxes, in my opinion, one of the most beneficial analysis is the proof of cash analysis. This is a bank statement analysis which traces reported revenues and expenses back to the bank deposits and disbursements. Um, it often exposes uh, differences in how cash moves through the business. So when you're looking at the accounting records of the company, those are going to be very much based on how the business is recording, when the items are being entered into QuickBooks, etc. How cash moves through the business can be best seen on the bank, the bank statements. If you think about your own bank statements, if you look at them, every few months, you will remember some of the activity that you did over the last couple months. You went out to eat one night, etc. When you look at the bank statements of the business, it gives you a understanding of how cash moves throughout the business. So when the company receives cash from customers, if it has to pay off monthly loans, if it already has an SBA loan, when the company processes payroll, if the company has one-time expenditures or has to settle a lawsuit, those larger items will very likely be obvious to see when it hits, the company's bank statement. So the proof of cash is something that I love doing early on in this phase two because it shows you and verifies at a high level that there's not a material misstatement in the business at the bank account level. Um, Additionally, I like to do things like operating expense review and a gross margin analysis. The operating expense review, and I'll do my best to zoom in so you can see it, looks at the detailed GL analysis and quantifies the expense items of the company as is it business related? Is it non-recurring? Are these discretionary expenses? Um, is are Will there be maybe personal expenses hitting operating expenses? Um, because doing this review give answers the question of what are the true operating costs of the business. Um, Operating expenses are the SG&A, which is in short can be including, especially in these small businesses, personal costs or non-business related costs. So by understanding what is the health of the operating expenses of the company, it can better educate you behind what are the true costs of this business to sustain revenues. Uh, by understanding and cutting through that noise, it can help better project what is the go forward profitability of the company. Um, Doing a margin analysis is very important, especially if you have a product heavy business. So if you have a lot of inventory on hand or you sell various SKUs of manufacturing components or any types of materials, understanding what is the margin by product you sell, what does the product mix look like, this can help understand what are the very profitable items of the business? Does the company sell a lot of those profitable items, or um, do they sell primarily, low margin items? So maybe there's one-time products that they sold, which are giving a short-term uh, favorable lift to this business. Understanding the gross margin by product, by SKU, et cetera, is a detailed analysis, which starts really at the financial statement level, um, in order to understand, what does it look like for this business? Two more things I like to do. Doing a detailed contract and customer analysis is should be something that's conducted on every deal. I recommend doing a top 10 customer analysis by month, by year, as well as looking at some of the top contracts and understanding, do these contracts automatically renew? Does the company even have any contracts? Are there certain terms in the contracts that the company already negotiated for some of the larger customers? Have they pre-negotiated pricing? Are there termination clauses if the company changes names or if there's a sale? So if you're looking to buy a business and you want to do an asset sale, pay close attention to the contracts because if the in an asset sale, likely you will buy all the assets of the company, but the name of the company will likely change if you are going to move it under a different one. That can trigger termination clauses in some of these contracts. So just pay close attention to those. If you want access to my financial due diligence toolkit, which contains, I think we're up to 92 pages about request list, some of the data documents you'll need, feel free to scan the QR code and you should receive a copy of this in your inbox, today. So if we need to go back to the QR code, I'd be happy to flip back up, but for sake of time, I'm going to keep it moving. So let's move into phase three. So picture this. We're going to pause for a second. You are under LOI for a business. You have kicked off financial due diligence. We have preliminarily validated the financials. So phase one is complete. Phase two, we have conducted the deeper dive of the analysis. So we've done the cash proof. We have done the customer review. Um, the financial diligence team has interviewed management. We might have calculated working capital, looked at accounts receivable, accounts payable, understand what is the cash conversion cycle of the business. All of those things came back clean, and now you have a verifiable EBITDA, which is the expected go forward earnings of the company on a normalized basis. If everyone's still with me, we can now move into phase three. So phase three is taking the base case of the company, and since we have the groundwork of the Excel financials, now it's putting together a financial model and doing some stress testing and putting together a pro forma financial model and doing last minute operational deep dive. So when we're at this phase, I like to start out with conducting a financial model. So it's typically a 3-year pro forma model, and you can use that for if you're trying to get an SBA loan. You typically will need a business plan and a financial model uh, as sort of your base case in your underwriting package. Uh, we work with a lot of buyers and put this together for them because they likely are doing a lot of juggling, especially if you're dealing with SBA banks, putting together, your personal financial statement, etc. From there, it's helpful to forecast the, best case, worst case scenarios of the particular business. So if you think about a financial model, it's going to look like, let's say the company's revenues declined by 20% in the first year. That would be a worst case scenario. Hopefully, after we look at the worst case of 20% decline, it'll show you, can the business still support the bank loan? So it'll use the income statements, have already been prepared in phase one and phase two, and it sets the stage for your financial planning model as you assume duties into the business. Uh, the stress testing and the forecasting is used to make a best case and worst case scenario to give you confidence if the business has some turmoil. First and foremost, you can support this bank loan. The SBA banks, in particular, if you begin to miss payments, they, given it's personally guaranteed, they immediately will, move you into stress testing your loan and making sure it's still viable. If it's uh, private credit, likely when you fall below certain ratios, your loan can be triggered. And it causes a separate set of circumstances, et cetera. By stress testing the model, it sets the stage for giving yourself some comfort around the viability of this business. So, what are some of the other things you should be doing from an operational standpoint? I like to do a know your customer analysis. So, if we think about the original customer contract analysis in phase two, knowing your customer is a deeper dive. So, it's looking at the customer viability from an operational standpoint. So doing a deeper dive into, how financially healthy is this customer? Do they have any lawsuits open against them? Are they have a good, strong history of paying on time? Um, Very often in small business acquisitions, if a customer, which is a top customer of the business, if they go out of business and you are owed, several hundred thousands of dollars from them from accounts receivable, you want to understand what's your exposure to their business collapsing and how does that impact your business? Um, you'll see this if you keep up with small business or even, headlines on CNBC. If larger companies go out of business, there's likely a impact across everyone who works with that company. Um, as they become delinquent on payments, it's a trickle down effect. And if you have several of those customers in your top customer mix, it makes the asset that you're looking to purchase very risky. So doing a know your customer report can give a lot of peace in mind. Um, Doing a recasted pro forma income statement, kind of already touched upon this. This will give you the ability to do a lot of metrics around best case and worst case scenario testing. Um, Putting together a free cash flow bridge is very helpful because it can show the model conversion from EBITDA to distributable cash. Think about the cash available for debt service, the cash available to hire more people, some sort of these things. Um, some of the other things it's helpful to do in phase 2 or 3. We talked about management interviews. I think this is a very important um, operational item that all buyers should do, especially for small businesses. Conducting formal management interviews, even if it's only one, can give you a lot of information around how does the company operate, who are the leaders of the company, and it really sets the stage for a more collaborative environment. When you are a prospective buyer, you're likely going to need to work with the old management team of the company following transaction close. You want to understand like who are the people behind this business that, for the most part, if you're at the phase 3, this is a business you see yourself running, you get excited about every day. So it's very important to conduct this sort of interview. The investment thesis validation. So once you have tested the buyer's assumptions, understand a adjusted EBITDA, you begin to validate your final investment thesis of, is this business worth the price I have set in the LOI? And how can we ensure that this is a smart investment? Um, if you're pursuing a SBA sized loan to buy the small business, typically it's an SBA 7A loan, you are going to be personally guaranteeing your net worth in order to gain access to this loan. If for whatever reason the business cannot support the loan, they have the right to recoup as much of the loan as possible through your personal net assets. So think house, in most states, not all, and you know every other asset that you own and personally guarantee. So I issue a word of caution only to further validate why conducting like an investment thesis and doing the phased financial diligence is very important because you want to understand and ask the question, can this business support the bank loan that I'm about to take on? Does it have enough cash flow to pay the monthly SBA loan payments or private bank loan payments? And if you're able to validate that the price you're paying is fair and reasonable and the business can support it, it gives you so much more confidence and a feeling of relief as you head into closing. Phase 4, so likely we are at the home stretch of your LOI. So if we flip back to the original, if it's a 90 days, we are in the last, 30 days before closing time. So this is a very exciting and stressful time. So really the phase 4 is to update and get yourself to the closing table. So very likely in the last 60 days, you've been doing due diligence on a company, but the business is still operating on a day-to-day basis. So you need to do a financial update. So the financial update is effectively rolling forward the financial document so you can see how is the business performing in the last 60 days that was not captured in this preliminary analysis. Uh, you want to understand, has the business materially changed in the last 60 days? Hopefully, it has been steady and consistent. But until you do this refresh, you won't actually know how the business is performing. I would issue a word of caution when folks want to avoid doing the update. I think at the very, um, at a minimum, conducting a quick refresh of the financials at the accounting level on, within the general ledger is another thing that can save you a lot of headaches as you inch towards closing. I wouldn't take the seller's word for it. If they say the business is doing, business as usual, you really want to look and get your hands around the general ledger of the company in these last 60 days. You want to make sure that the business is sustaining the level of earnings that you expected from day one of the LOI and it's continuing through. Other things which are very helpful, you're going to do a working capital true up. So you're going to recalculate working capital against these new financial numbers, and it's going to set up the stage for an accurate opening balance sheet. So on day one of the company, you are going to need to do an opening balance sheet of incorporating the purchase accounting and debt structure into your new acquisition. Open balance sheet accounting is a complicated exercise. So based on the structure you choose and how the business was purchased, this is going to look a little bit different for everyone. Uh, Working with a CPA firm and an acquisition accounting team specifically should be able to help do opening balance sheets. If you get this wrong, it will cause a lot of headaches and pain later on in the process, especially when you're doing your first tax filing return. Getting the balance sheet on day one correct the first time will set the stage just for a more clean transition period. One thing I like to do at the end is a final red flags review. So this is going to be taking into all the findings during due diligence and checking the boxes that there have not been material changes for whatever reason in the last several, weeks or the last few months before the deal closes. So you'll see here in phase four, it's primarily doing some forecasting, wrapping up that, doing the financial update and validation, aligning, coordinating with the tax and legal folks, and then moving towards closing and that opening balance sheet exercise. Um, this is just something a little bit more about our group and something you can expect in the phase four. So typically, you're going to be getting the recasted financial model, an executive summary report, which you can be used for investors, lenders, etc., as well as the working capital analysis, which you can use as sort of your operating playbook for your FP&A and your financial planning as you assume duties as that new business owner. Here is sort of the snapshot of how we protect your investment from LOI or the discovery phase through closing. So again, this is, the week by week phase due diligence analysis. If you want to learn more about this and how it relates to your deal, I'd love to double click in it. But effectively, this is a proven playbook we've used for hundreds of acquisitions, and it really sets the stage for a clean and easy due diligence period and saves you a lot of time, money, and effort. Again, as the transaction CPA advisors, our expertise is in these small businesses. So, thinking about speed to closing, working with trusted partners is some of our specialties in this, self-funded search, independent sponsor, and private equity provider role.